Good afternoon, everybody. Happy Friday. Welcome back to the weekly market analysis for the week ending February 2nd, 2024. We are into the second trading month of the year, and it appears that even the Fed cannot stop the markets from going up, although, it looks like they tried. And of course, we've this week once again had another example of how the markets don't know how to have a 1% plus drop without everybody freaking out and talking about the end of the world already. We're going to look into whether or not this rally is poised to continue, what factors could be affecting it, part of the bullish argument, part of the bearish argument, a couple of other things outside of equities. And before we do, I'd like to remind you to hit the like button, subscribe to the channel if you find this content helpful. You can also find me on Twitter at Mr. J. Thomason, and you can subscribe to my weekly newsletter at befinanciallyfree.substack.com. I share all of my insights on a weekly basis absolutely free in 2024. And one of the things that you could do if you look at the newsletter on a weekly basis is you get my insights, including generally what I'm looking at as far as direction for risk assets during the next week. And of course, this last week, I wrote that the most likely direction for risk assets was to the upside. And despite the fact that the Fed tried supposedly to crush the markets and market expectations, the markets indeed were up. S&P 500 was up 1.3% this week. I'm looking at the futures. The NASDAQ was up 1.17 this week. I'm turning this into green for support. The Russell was down almost 0.1 almost 8%, I should say. And so the Russell was relatively weak, and then the Dow was up 1.3%. So in general, assets were up. If I were to go to Bitcoin futures were up on the week. Gold was up on the week. Silver was slightly down. Crude oil dropped 7%. That's a nasty engulfing weekly candle on the crude oil chart. That's going to obviously, with energy prices down, it's going to be supportive of risk assets. Nat gas was also down on the week. The 2-year bond was down on the week. The 2-year note was down on the week. 10-year note up on the week. 30-year bond up on the week. The dollar up on the week, especially after today's price action. And I think that's where I'll stop on the run through. But what I want to do now is I want to ask the question, are the markets poised to continue to the upside over the next week, or are we looking at maybe a consolidation or a correction? So we want to try to look at the bullish and bearish arguments. And one of the things I want to just mention right off the bat is that a lot of people are making a lot out of Powell, Fed Chairman Jerome Powell, being on 60 Minutes this weekend, or on 60 Minutes recording, I believe yesterday, and that's going to air on Sunday. A lot of people are making noise about that, as well as today after hours, after the markets were closed, the Biden administration announced military action that it took. So a lot of people talking about the timing of not only Powell this weekend, but also the U.S. government announcing their action after the markets closed. A lot of conspiracy theories out there. We had some economic data this week that we'll talk about. So if we start from the big picture macro level, I already kind of went through what was up this week as far as risk assets broadly. What I want to do is I want to take a look at some economic data. And one of the first things that I'll show you here is the NBER business cycle indicators. And of course, in this chart, the kind of the gray bars is the pre-COVID trend. The yellow bar is last month's reading, and the bluish bar is this month's reading. And you saw we got on the non-farm payrolls this week, just came out today. We got a recovery in the household survey employed It was still down on the month by 31,000, but not nearly as much as it was the last month. And then we have gotten over the last few weeks updates to the right side of this chart, or the right chart, where we're seeing still seeing decline in industrial production, but we're seeing strength in the consumer, in retail sales, consumer spending, in the expenditures category, as well as in personal incomes. And so, by all accounts, the economy is still strong. So that was obviously a big win. We had jobless claims come in earlier this week above expectations. So the markets positioned themselves yesterday for weakness today in the job market report, and of course we'll look at the price action that happened today in just a minute. Earlier this week we got ISM manufacturing data. Next week we'll get ISM services, and the updates to this data were we're still seeing declines in some pretty significant categories, but we saw improvement. So actually we saw on the negative side, we saw an increase in prices. You can see where my mouse is hovering over towards the right side. A decline in employment. We saw basically same levels in production. We did see an improvement in new orders, an improvement in imports, but also a boost in inventories. And at a composite level, we are at a 49.1 on the PMI, which is in contraction territory, but it is an improvement from last month's, and it was above expectations. So we had that data come in. We had, let me see if I can find it here. One of the big things that is being discussed is the weekly hours versus the hourly earnings. So there's a lot of discussion being had about the decline in the average weekly hours being something that is somewhat recessionary, and so that's obviously not something that is desirable. But then at the same time, we got a huge boom in the 3-month annualized rate of average hourly earnings, and so this could be concerning. This indicates that there could be some price pressures that are coming from the wage side, which is not what the Fed wants. So on balance, the payrolls beat today pretty significantly, and the hourly earnings were much higher than expected. And so the markets, of course, from an economic data standpoint, the markets initially intraday, if I go to a 1-minute chart to kind of show you what things looked like when that data was released. You see here on the S&P futures, we dropped 18.5 points on S&P futures in that first minute alone, and at one time, had gotten down had come down to about 49.25 on S&P futures, and of course we closed at 49.80. So we saw the rest of the trading day from that point just essentially a massive recovery, all the way up until about 45 minutes ahead of market close, or NYSE close. We kind of came down and closed at about 49.72. So a lot of people thought that, oh, and actually let me take a look at this too. I want to show you. We had a huge rise in the U.S. dollar today, giant engulfing reversal candle. If I turn on my reversal candle chart overlay, you can see this is definitely a reversal candle, and if this actually coincides with some positioning data that suggests that people are relatively short U.S. dollars here, and so this I don't know that I would take this necessarily as a reversal candle to buy, just because it's pretty powerful, but also it came with economic data that was outside of the expectation. So the payrolls beat caused a huge boom in the dollar. It also led to a pretty significant rise in the 10-year yield. So a lot of people suspected that this would put pressure on markets that they would be red, and it's entirely likely that they would. If you look at a heat map of the S&P 500, let me see if I can zoom this a little bit differently here. I don't know if it's going to work. It's not. So, but anyway, you could see the big one here was Meta, was up 20.32% on the day. You also had Amazon up 7.87. on the day. Both of those were up huge because of their earnings reports. Meta, I believe this is the first time that they've announced a dividend, which is something they have not had ever. So that was obviously, I think, a help. And plus, they really they beat their earnings really well and provided higher guidance for the next quarter. So that was, I think, the difference, the biggest difference in the markets today. You can actually see, you can actually see that there's actually quite a bit of red today. If you want to look at the ETFs, sector ETFs, technology ETFs were up, consumer cyclicals were up, and financials were up, but the other sectors, industrials were up too. But so 4 out of the 9 sectors were up, but that's obviously not even half. That's not half the sectors. So it's a pretty narrow rally for today, and you can also see that in the fact that the S&P 500 stocks above their 50-day moving average actually dropped 7.6% today, despite the fact that the S&P futures were up over 1%. So if you look at the Russell 3000, which is obviously it's like 95% of the investable stocks on the market, and it was also down 8% in its stocks above 50-day moving average. So the largest percentage of stocks today actually came down, and so I think that that's interesting. It's entirely likely that if not for Meta and Amazon and a couple of the other names that were up today, that the markets would actually have been down pretty severely. So I think that that's something important to take into account, and it makes you wonder then if this weekly chart, if it would have been different, if it would have ended differently. So I think that is something to point out. So anyway, this market data is for the most part maintaining Goldilocks trend, although I would argue that there is some shoots of higher inflation, or of inflation potentially turning up. I think there's ingredients for it, so I think we have to be aware of the possibility of a shift in terms of the regime here, but we just have to keep watching the data to kind of see. Unemployment stayed around the same level. One of the really big things was that job openings ticked up, but then at the same time quits ticked down. So that was really interesting to look at. And I think from a economic data standpoint, that's kind of what I wanted to look at. So economic data is pretty supportive of stocks. Not so supportive of bonds or of gold, like precious metals, and I don't think very supportive of energy prices this week, over the next week. So I think that that's something to point out. Okay, so what about what are some reasons to be bullish stocks? So despite what was going on this week, the VIX. The VIX was up on the week, but it's still relatively low. As long as the VIX is relatively low, risk assets can continue to go up. I already mentioned breadth indicators. I like to use the stocks above their 200-day moving average. As long as this is above 50, then there's healthy enough breadth to provide room for risk assets to go up. If you want to look at technicals, if we put our MACD and our RSI here, then we're not at overbought levels on S&P yet. We're not at overbought levels yet on NASDAQ. So this can obviously continue. One of the things that I was looking at was this divergence that had been developing on the MACD, so technically speaking, because the MACD histogram has gone back up and the signal lines have curled back to the upside, technically this divergence was nullified. But what I will be looking at to see is if price actually comes off over the next week. That might be a signal that indeed prices are going to come down. but obviously you have to wait for that signal. You can't be preemptive in that signaling. The NASDAQ, same thing, saw an increase on the MACD histogram, or a higher level, so that signal could be nullified at this point. On the Russell, it's actually seemingly pretty bearish still. It's still relatively weak in comparison to the other indices, so it looks like, from my observation, it looks like if you were gonna, buy one thing and be short the other thing, I would probably say that you would want to be long S&P, short Russell, but obviously that's not financial advice. And then we'll just leave the Dow alone for now. I want to take a look at a couple other things. I've been looking at this a lot recently. This is a chart showing you the mutual fund and exchange traded fund flows. And so if I go from left to right, you've got total flows, then you've got total equity, domestic, world equity, total bond, taxable bond, muni bond, commodity. And what I have been pointing out more recently in my newsletter, as well as on Twitter X, is that we're seeing the same kind of setup that we saw back at the beginning of 2023, where you started to see a lot of outflows in the equity sectors, but then a huge inflow into bonds. And so, actually, let me see. I think I have to fix this really quick. Yeah. Okay. There we go. Sorry about that. So you see that you see the green bars here, which is the current estimate for the month of January, is extremely high for bonds, and so if I could take a snapshot. If I could have taken a snapshot from January, February of 2023 and put it next to this chart, it would look almost exactly the same. You saw a lot of outflows in equity and inflows into bonds. Everyone was playing for the recession. And I think we're seeing the same sort of scenario play out. And there's a part of me that looks at this and says, well, I feel like it feels like the pain trade for most investors is that equities go higher, bonds go lower. Because really economic strength should result in stocks higher, bonds lower. And that should be favorable to stocks, particularly until bond yields go up so high that it actually becomes harmful in terms of duration, especially in tech stocks and things like that. So if you look at the flows, the fund flows, it's suggestive of opportunities for stocks to continue to go to the upside. Now I want to jump over really quick. I'm going to show you my positioning charts because what I'd like to zoom in on, let me see if I can get this window set up properly. If you look at the S&P 500, what you actually find is that the speculators, at least the larger speculators, are getting shorter the S&P 500. And what you actually see if you go back, when non-commercials, which are your larger speculators, when they got short, in August, September of 2022, and then got short again in like May of 2023, that was fuel for these large rallies. If you want to go back, obviously, to when you go into August, September, right, they're getting super short, and that was actually like right around the bottom. And then when you go into May of 2023, prices had already been coming up, but right around here is where everyone was getting really short, looking for this to roll over, thinking, oh, recession is finally going to be here. And then, of course, we ended up having a really hot summer. So that's something that I have my radar screen up for, because to me that is also supportive of assets actually moving to the upside rather than to the downside. So I think that that's kind of important to point out. Now, what would be some evidence to suggest that risk assets might be getting a little too ahead of themselves, at least as far as maybe equities go? You can see the AAII Investor Sentiment Survey percentile ranking. This chart is showing you bullish, neutral, bearish, and then the spread between bulls and bears. And we're in the 87th percentile in bullish sentiment, 85th percentile in the spread between bulls and bears. So that's obviously getting really, really extreme. What I would want to see, if I were thinking that we were due for a reversal downside correction, I would actually want to see the bearish sentiment go down maybe below even the 15th percentile, and maybe the bullish and the spread between bulls and bears go up above the 90th percentile. And that may happen over the next week because obviously risk assets made all-time highs, or stocks have made all-time highs now. And that's obviously usually pretty bullish, and there's a psychological effect there. So I would call that out as well. So in terms of equities, I would say the technicals are relatively supportive of further upside. I would say that the economic data is pretty supportive of upside, and the positioning and flows are relatively supportive of further upside in the markets. Whereas dollar strength, this could be a negative development that might actually put pressure on risk assets. If yields continue to rise, there can be a point where they are dangerously high. It is interesting to note that at these levels was kind of where the cross-asset correction started to happen, but we've seen that multiple times where the yields have come up, and then it got to a point where even though risk assets were going up, it got to the point where everything was getting the yield was coming up. It was too much pressure on duration assets like tech stocks and things like that. So you see that at multiple points where eventually you see the turn, and then that coincides with the yield really pushing further and further to the upside. So if bonds and the dollar continue to go to the upside, or if the dollar continues its uptrend, which it looks like it will, and if yields can start curling back to the upside, that would, in theory, put pressure on risk assets. And then the other thing, on the bearish side is, while breadth is relatively healthy, I don't like that the indices are making higher highs, like new all-time highs, and going higher, but the breadth is rolling off. I don't really like to see that. I also generally don't like to see, if you look at the VVIX to VIX ratio, you'd like to see this moving to the upside. So you can actually see, if you go back to November 2021 and December 2021, you get a cross of this ratio in terms of the tide indicator, and you can see bearish tide. And then once you get to 2023, it crosses back, and it's been relatively solid ever since then. Of course, you see we had the summer correction, the trend started to come off. So it's concerning to see the ratio, the cross underneath its control line, and because if this starts to trend downward, that would suggest that a cross asset correction could be coming. You generally, in a healthy market, you would want to see small caps as an outperformer versus the mega caps, or versus, I should say, not the mega caps, the large caps. Typically, not always, because you can actually see across 2023, mega caps, large caps outperformed, and the market still went up. So this is not as trustworthy an indicator. And then again, same thing on value to growth. Often in a healthy market, you would want to see value outperforming, but in this case, value hasn't outperformed in a really long time. So that's not necessarily as trustworthy. It's more like you have to take them in tandem. And then you also want to see high beta to low beta continuing to go up, as it has essentially since the lows around October, November, December of 2022 and coming back to the upside. So that's what you want to see generally over time. And these are not all confirming, so I think that's something that's concerning as well. My gut says that prices are up next week, but obviously that's just my own opinion based on what I'm looking at. And of course, usually over the weekend, this is why I always encourage everyone to go check out my newsletter, because what I often do is in these videos I give kind of my gut reaction to the price action and the events and the data of the week. And then it's when I really dive in over the weekend and I put my thoughts into my newsletter that I really get a good handle on what's going on currently and what's most likely to happen over the next week. So that's why I would encourage you all, if you're not already subscribed to the newsletter, to go do so. Let's see. I want to take a look at gold. Gold's been kind of just grinding to the upside, obviously, ever since the Friday before the Israel-Hamas conflict happened. Ever since then, the gold has been just going up higher and higher, but it's kind of just been going in this sideways range, consolidating underneath its all-time highs. Obviously, we know that it did trade on a couple of occasions above the previous all-time high, but it has not been able to really get above that and stay above that. And so that's what I'm looking for right now is for gold to get a sustained move above. And until it does, I don't suspect that gold will be super valuable as a trade for anybody for a while. I think probably the most overdone thing that I'm seeing right now, let me turn off the tide indicator really quick. I feel like the most overdone thing that I'm seeing in terms of the gold chart right now is the cup and handle, which I would like to just go out here and say that if you go back and find videos that I made from 3 years ago, I think it was March or April of 2021, I was talking about cup and handle pattern, and of course that was getting nobody's attention. I think that if this was going to be a true cup and handle, that it would have played out already. But I'm seeing a lot of people looking at cup and handles and talking about how this means that gold's going to go up to 2,500 or 2,600. I don't know. But what I do suspect is that if everyone is looking for that pattern to play out, then it's probably actually not going to play out. So that would be something that I would call out on that issue. And then as well, I was saying this a lot in 2023, that it's not likely that gold really has legs underneath it, despite the fact that the Fed may indeed cut rates. The biggest thing that's a headwind to gold is growth. Gold is a deflationary hedge. So when deflation happens, that's when you want to own gold. That's when you want to trade gold, and that's not where we're at. When there is growth in the markets, or when there's monetary tightening, your gold is not going to generally be very successful. Despite all the fact that liquidity has been rising for some time on balance, gold has yet to go anywhere, and that's because gold is a proxy for growth, not a proxy for inflation. Although people think that inflation is the thing that matters with gold, so I would say that gold right now is acting as if people want it to go up because they believe it should because of the potential for rate cuts. But the reason gold is not going up, to me, is because growth is still strong. Now, on the other side of this, one of the kind of red flags here is crude oil. Crude oil is coming off despite the fact that there is actually increasing geopolitical tension. Obviously, you remember, if you've been paying attention to this channel, to my newsletter, and to my tweets, that I've been really loud about crude oil pretty much ever since right here. I don't know a single person who was bearish gold bearish crude oil when it was 90, but you can go find tweets on my timeline where I'm talking about, starting to look for shorts, and that it's overextended, that it's the positioning was too extreme, and we've pretty much, it's just been down ever since then, right? From the day that I shorted oil, and that I called for oil shorts, oil is down 21%. So, right now though, there's no edge on crude. I actually am more bullish right now generally, but I don't have an edge, so obviously there's no trade in crude oil right now. This could waterfall down into the mid 60s. I would be looking for oil to find support around 65 to 67. That would be a good spot to buy. But then if it broke below that, then what is there between this level and say 55 or maybe even lower? So that's kind of the read there. And as long as energy, like if I could go to my futures charts and take a look at gasoline, as long as oil is down and gasoline is down, it's really hard to see a situation where there is any sort of increase to inflation, at least from the energy side of things. So anyway, to me, it's interesting to note what oil is doing, because if economies are good, then oil, you would think, would have more of a bid. But there's a lot about China. China's in the middle of a deflationary spiral right now, and I suspect that has something to do with oil's price down. I know production is up. I think Brazil just came out today with some data showing their production was at record highs. So I know that there's a lot of pumping going on, and I know the Biden administration is trying to do everything they can to keep the price of energy down for the sake of to service their election needs. But it is interesting that crude oil is acting deflationary, acting somewhat recessionary. Gold is trying to go up as if it's recessionary or deflationary, but then it's not. But then all the economic data is actually showing growth is strong, and that inflation is coming down. So it's just an interesting concoction of things happening right now. And so there's not a lot of certainties other than that it seems that U.S. exceptionalism in terms of economic growth is going to probably continue, which means that the best place to be, at least right now, seems to be the stock market, right? And this is ultimately why, this is all about conditions and probabilities. And so that's why one of the things you find in my newsletter is my overlay chart, which shows you in the top panel the general, like at least for this one in terms of equities, it shows you kind of the general overarching big picture. So obviously in this, when you see green, that means that conditions are the safest for, in this case, stocks. And when it's red, it's when it's the least safe for stocks. And then, of course, the bottom overlay, the lower panel here, is where you actually take the tactical longs and shorts. So the way that you would use this in tandem, I can just show you, is when you've got the top overlay showing green, and then, get this. When the top overlay is showing green and the bottom overlay is showing red, you reduce the risk, and then as soon as that thing turns yellow or goes back to green, that's when you take that long entry again. On the flip side, when the top panel is red, then green is typically where you can take small positions, but you would generally take that opportunity to get rid of any positions that you are still in. And then, of course, when you see double reds, that's when its conditions are most conducive for taking shorts. So if you're into shorting, and shorting is obviously very, very difficult, so I'm not recommending that at all. Anyway, so that all I'm saying is that because so much is uncertain, you have to develop systems, systematic overlays and systems that will help to cut through some of the noise and help you to see when the conditions are right for the various asset classes that you buy into. And so that's what we do here. And when things look as uncertain as they do, you just have to stick with something that takes the guesswork and the emotion out of it. So right now, the overlay says it's safe to be in the stock market, and so we're going to comply with that. And that's where we'll stop for today. Thank you for watching. I hope you guys have a great weekend. I'll see you guys next time.